to tackle the first thing that was on everybody's mind when they woke up this morning, which was the snow, of course, and a huge storm coming across all the Northeast. Is any of that going to have a longer-term impact on the crude oil price?
You know, I don't think so. I lived in New York for a long time and certainly can appreciate how it feels there, but I live in New England now and the roads are already clear. It's just a temporary event.
Okay. In the meantime, though, you can't deny, though, that the winter has been pretty darn cold. I mean, isn't that going to keep a bid, though, under those prices?
Yeah, that's far more important. For example, if you look across the northern hemisphere, it's one of the coldest winters that we've had for a long time. In Germany, it's been 15% colder than normal, and in March, we're projecting it'll be 15 to 20% colder than normal in the United States. That's far more important than the snowstorms.
Okay, so how's that going to translate in prices then in the next few months?
Well, there's a perception, particularly given what's happened in energy and metals prices over the past month, that there's been a sharp decline in the commodity outlook. Actually, if you look at what happened in the fourth quarter, prices rose just as sharply, and so we've just done a round trip. We're right back to where we started from 6 months ago. So I think the emphasis should be on the Chinese New Year. As we clean up from snowstorms here, they're cleaning up from snowstorms there. The difference is, this weekend we're going to go into Valentine's Day. They're going to go into the Chinese New Year. And once those holidays finish up in the next couple of weeks, there's going to be a very strong bid coming from China. Just to give you one number, in the month of December, China imported 5 million barrels of crude oil. That's an enormous increase above its trend level. In January, it was reported yesterday, China took only 4 million barrels. So there was a sharp decline. We'll probably see that pick up again.
But then you've got people like Mark Fomber coming out and continuing to make these comments saying that, look, you know, this talk about demand coming out from China, this talk about the economy heating and eventually overheating, all of that is overblown.
Yeah, you know, I think sometimes there's where you stand depends on where you sit and what time frame you're looking at. Certainly over the next couple of weeks, with the world's most populous country enjoying a holiday as the year of the tiger begins, there will be a slackening in demand. It would not be surprising to see copper pull back to $5,800 per ton, maybe even a little bit lower. But I think the emphasis should be on looking at those commodities that get into the second half of the year that have much stronger prospects as the tailwind of fiscal and monetary stimulus really pushes up the demand outlook. And you know, there I would think copper and crude oil should definitely be benefiting from those factors. Okay,
so aside from the demand story, which will, as you say, put that bid under the prices for these commodities, what though could make us break to the downside?
Well, you know, obviously in January, the call it overbought condition in equities, which were priced anywhere from 25 times to 75 times earnings, depending on which national index you were looking at, suggested that equities were priced for perfection. So as that comes off, sometimes commodity markets will trade in sympathy with equities, and that creates some doubt about the forward demand prospects, particularly because inventory restocking clearly was driving the U.S. and Chinese numbers most recently. But when we look forward, if I look at the copper balance, for example, in China, China is the world's largest producer and consumer of copper. The gap between the two is larger than the entire consumption of the United States, the world's second largest consumer.
Really?
They have to come to the market.